Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to a little M&A in the media space. The Warner Bros. Discovery deal, the never-ending deal, seems like it's moving a little bit forward here. We got a higher bid from Paramount. We want to check in with Geetha Ranganathan. She covers all the media stocks for Bloomberg Intelligence. So, Geetha, give us the latest on this Warner Brothers Discovery sale process. Where are we right now?
Yeah, so Paul, we got the higher number from Paramount. It's $31, so they upped it from $30 per share for the entire company. Now, what that has forced the Warner Brothers Discovery Board to do is to go back to the drawing board, kind of re-engage with Paramount, see exactly what number they can come up with. But ultimately, they have to deem whether this is a superior proposal or not. So far, they have two offers on the table, this one from Paramount and the $27.75 per share from Netflix, but that is only for part of the business. That's only for the studio and the streaming assets. So they're still in the process of making a determination about which offer is superior. But the minute that they make that determination and they call the Paramount offer superior, then the clock starts ticking for Netflix. They have 4 days to come up with their own enhanced offer, so to match the Paramount offer. And then, we'll kind of see where the chips fall after that.
Yeah, well, Geetha, I recall the Warner Brothers board really did not like some of the financing terms for the Paramount bid initially, right? So does this new improved offer improve upon some of those sticking points in the earlier deal? And does that really de-risk the transaction now that they've come up with another offer here?
They have all of the points that Warner Brothers had initially raised. They have the Paramount management team has proposed remedies. So one of the big things that they have kind of come up with is that they're going to cover the financing costs and the termination fee if Netflix exits this process. They actually upped their own termination fee from $5.9 billion to $7 billion. They are going to pay something called a ticking fee, which is 25 cents per share per quarter for every quarter that the transaction does not close beyond September. So they've offered a lot of different things, including kind of backstopping the whole equity portion of the deal, as well as providing guarantees for the debt financing. So a lot of the points that Warner Brothers had initially raised, you're absolutely right, Kristine. Paramount has kind of come out and addressed that. So definitely providing a lot more comfort to the Warner Brothers Discovery Board.
Yeah, Geetha, you're right. It seems like Paramount's really stepped up and really said we're going to be really credible here. Meanwhile, Netflix has been quietly waiting on the sidelines, not really doing anything. But it now seems like now's the time for them to, really make a decision, step up with a bigger, better offer, different offer. I'm not sure. What do you think the options are for Netflix?
The best option, in my view, Paul, for Netflix, and I think majority of its investors would also agree, is to just walk away, pocket the $2.8 billion that you get in termination fees, just walk away and just focus on your core business, because they do have a very strong core business. As we've said many times, Paul, and you agree that this, Warner Brothers is a great asset. There's absolutely no doubt about it, but it is really just a nice to have, not a must have for Netflix. So it could end up actually becoming a distraction. So, in many cases, I think the way that, the street almost perceives it is that Netflix is a winner if they lose this whole bidding process. But that said, they do have a lot of financial firepower. If they did have to increase their bid, up it by about $1-2, they absolutely can do that. The only thing is, once they go beyond that, then they kind of risk overpaying for the asset. They risk their leverage profile really kind of getting a little bit dangerous, I would say. Gross debt is going to be well above $100 billion. Leverage could be at 4 times. They're at 0.6 times right now. So, all of those things start kind of coming into question. But of course, they have a great free cash flow profile, so deleveraging wouldn't be an issue. That said, there still are, integration and execution risks always with any M&A deal.
Yeah, well, so if Paramount does indeed win the deal, does that present stronger competition for Netflix, at least in the streaming space?
I mean, it definitely will to some extent, but I think what Netflix and everybody else is banking on is that leverage is just going to be so high for the combined Paramount Warner Brothers Discovery that, at least for the first couple of years, I think they're just going to be really focused on kind of driving costs down, hitting their synergy targets, not really being able to invest in the business. But again, it all comes down to exactly what the number is going to be. But you're right, they definitely will be a stronger competitor, although I don't think it's going to be a make or break for Netflix at all.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's move on, though, to John Tucker. One of John Tucker's favorite stocks, and that is Lowe's, reporting results. And let's bring in...
I'll say the difference between Lowe's and Home Depot, I find more women at Lowe's than Home Depot.
Nice to know.
Yeah.
Well, I wasn't saying that.
Okay.
I'm just saying, my observation.
Okay.
Yeah,
why is
that?
I wonder.
It's more like non-professional friendly,
It's like
I guess.
More DIY. But
apparently Paul's going there to pick people up. So,
can I just say that the demographic of women might not be interested in you, Paul?
Okay.
Yeah.
Yeah, no surprise. And John Tucker, speaking of do-it-yourself, he just fixed our microphone here in our studio, folks. We had a professional come in here. John's like, no, I got it.
Yeah.
I got it.
that's okay.
We
do it all here.
Don't worry, Anthony. We got it.
Very much a product of Lowe's DIY. But all right, so let's get to Lowe's. What is the preview there? And with that, let's bring in Drew Redding, who is the Bloomberg Intelligence U.S. home building analyst. Drew, what is going to be the takeaway?
So Lowe's reported earlier this morning, and overall it was a solid quarter. They had a nice beat on same-store sales, really due to the strength of their professional customers and their e-commerce channel. They had about a 50 basis point lift from recent storms. You see the stock is down about 4 to 5%. There's a couple of things going on there. They guided the same-store sales for 2026 being about flat to up 2%. While that's exactly, in line with what we heard from Home Depot, consensus was on the higher end of that. We think there could be a little bit of conservatism in there, which rightfully so, given where we are with housing. Also, there's a modest earnings reset for the company. The midpoint of their guidance was about 4% below the street. And really, that's a reflection of weaker than expected operating margins. And that's largely due to some of the acquisitions they've made over the last couple of years. So there's a little bit of company-specific noise in there. The other thing that's going on with the stock, and really, if you look across the housing space as a whole, whether you're talking about the builders, the building product manufacturers, developers, really anyone, they're all red across the board. And I think that has to do with the lack of dialogue around housing policy during the State of the Union address last night. We heard a victory lap on mortgage rates, which have certainly come down. But it was really just a reiteration of the administration's plan to ban institutional purchases. So I think a lot of investors, across the housing landscape, including home improvement retailer, we're hoping for some policy that could really stoke the housing market.
So I'm looking at the Mortgage Bankers Association 30-year fixed mortgage, 6.09%. That's as low as it's been in a long time. Is it low enough to get folks out of their homes, and free up the existing home buyer market?
Yeah, you're right. We're about 100 basis points below where we were just a year ago. And certainly every tick lower in mortgage rates is going to help bring that incremental buyer off the fence. Typically what we hear is that something in that 5.5% range is kind of that magic number. Now, that being said, as we've said for a long time, it's not just about mortgage rates. They've certainly helped affordability. They've brought monthly payments down, but home prices continue to rise. They're up more than 50% since 2019. So when you look at a more holistic view of housing affordability, it's still really constrained. The other thing that we continue to hear, whether it's from the retailers or from the builders, is that buyers are increasingly concerned about the economy. They're increasingly concerned about the outlook for the labor market. So there's a lack of urgency out there. You also have a lot of people maybe sitting on the fence because they're saying to themselves, look, maybe home prices are going to come down. Maybe rates are going to come down further. Maybe I should wait before making such a big purchasing decision.
Yeah, well, so if that sort of turnover, new housing buyers, that's still going to be stalled given the uncertainty in the macro environment, would something like repair and remodel spending, that segment of Lowe's customers, is that something that's going to be enough to carry them through? And I suppose for the rest of the house building sector?
Yeah, so for the home improvement retailers specifically, I think demand has been pretty stable, if not modestly improving. If you look at comp store sales on a 2-year basis, there was a little bit of an uptick this quarter. So I think their customer has been pretty resilient. When you think about what's holding back more robust growth in the sector, it's really that big ticket discretionary spending. These are categories like large scale kitchen and bath remodels, maybe a big flooring project, replacing all the doors and windows in your house. And these are things that typically tend to be financed. So with rates at an elevated level, you've seen a pullback in that. And it also goes back to what we said on confidence. With less confidence in the home, the direction of home prices, you have people who are maybe waiting to take on those bigger ticket projects.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're going to be talking a little bit about retail now. And for that, let's bring in Mayor Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst, joining us from sunny LA, very different from the weather that we're seeing over here in New York. Mary, thank you so much for joining us. Let's start with TJ Maxx, because we did get that disappointing outlook from them. And very surprising, right? Because they did have a strong holiday season, but it seems like they're guiding expectations now for the future. What's the takeaway from that? Is this whole customers trading down to more affordable goods, is that flux over now for TJ Maxx?
Thank you, Kristine. But actually, TJX is known for providing conservative guidance. So even though this guidance is coming in below what analysts expect for the first quarter, already, if you look at the first quarter, and the company said this, they're off to a great start. When we looked at the Bloomberg second measure transaction data, we're seeing really robust sales. So it looks like a huge beat right now. The trend that we're seeing, it's very early in the first quarter, but it's looking very, very strong. And I think when you think about TJX, this company, the management team here executes so seamlessly. And the brands that they have, which include Stuart Weitzman's jeweled sandals, for example, you can get rag and bone attire. Yeah. And consumers love it.
So, I mean, I am looking at the stock actually is up about 0.9% today at a 52-week high. So good news there. Mary, what's the company saying about the consumer out there? You know, we've got the K-shaped economy. I'm not sure how TJX kind of plays within that marketplace, but what are they seeing?
Yeah. So, Paul, you raise a valid point, the K-shaped economy. The thing about TJX, when you think about all of the off-price retailers, they're in the best position to appeal to consumers across all income cohorts. So they've got the brands that include Celine, Chloe, Gucci, Brunello Cucinelli, but then they'll have brands like Theory or Eli Tahari. So Nike, Puma. So they really cover brands across the spectrum that appeal to consumers across both the high end all the way down to those consumers that are really paycheck to paycheck. And so that's what makes them in a great position and why their business model really works. And when you think about home goods, everybody shops home goods. Whenever you go to a dinner party, what you're seeing there on the table likely came from home goods.
Yeah, well, very interesting in the retail space, kind of the developments that we're seeing as a result of that K-shaped economy that Paul mentioned. Because, you know, in contrast, we did have the Saks CEO, of course, on Bloomberg TV yesterday talking about where they are in the Chapter 11 process. But they're also saying that, you know, hundreds of luxury brands are shipping again. And then at the same time, you know, TJX holding up relatively well. What does this tell us about the state of consumers? You know, are you seeing some kind of a bifurcation where certain segments are doing better than others?
Yeah, so I would say that we're seeing strength across all consumers really, and you see it with the consumer confidence data, but most importantly, I think whenever you have strong employment, which we have had for many years now, and that really keeps the consumer resilient. So even if you're sort of going paycheck to paycheck, when you're employed, you feel really good. And you might cut back on some essentials just so that you can get something new that makes you feel good. So I really see strength across all consumer segments. It really comes down to the retailer and their ability to execute. So when you see companies that are outperforming, it's because they're executing. And that's really the delineation that we see there.
Hey, Mary, the Supreme Court and our president just brought tariffs right back to the front burner again. I wonder if the good folks at TJX had any thoughts about what seems to be a new round or a renewed interest in tariffs.
Yes, well, so the tariff question is going to be top of mind with fourth quarter earnings coming in. And TJX, though, because they buy primarily closeouts, like less than 10%, they're sourcing directly. So they're really not that impacted by tariffs. It's so small for them. Because like I said, over 90% of the inventory that they're sourcing is closeouts. And they see tremendous availability of closeouts, so they're not impacted. But we did have news out today that Steve Madden decided not to provide margin guidance. They did provide sales guidance, which was strong, but they decided not to provide that guidance because they felt that there was some uncertainty. But when you look at it, we already know the tariffs that went into place prior to the 10% that went into effect. So you know that you get at least a 50% savings for 150 days on new shipments. And then once they issue the executive order for 15%, then you'll have a 25% savings. So that's really the best way to look at what the margin impact could be. And most of these companies are passing on those price increases, and then they're also employing other mitigation measures, including sharing with the suppliers.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Certainly, if you're a tech investor, you've been dealing with the other side of AI, which is to what extent is AI a threat to my business? And that's been a real big problem for a lot of sectors out there, including software. Software as a service has certainly been dealing with that over the last several weeks. We're going to check in with Anurag Rana and get the latest there. Anurag Rana is a senior tech analyst, covers all the tech stuff for Bloomberg Intelligence. Anurag, talk to us about the conversations you're having with institutional investors these days, because several weeks ago we saw just a big sell on your whole software sector there. Where are we today on that?
It's been okay the last 2 days, and things will probably change by the time next week comes around. Because the discussion around here is not so much about what's happening to the earnings power or sales growth over the next 12 to 24 months. The big question is whether these guys will be relevant 5 years from now or not. And when you put a question on somebody's terminal value, then there is no argument. It's a 1 or a 0. So there are those that think that some of them will be fine and maybe even grow stronger. And there are certain companies that will be disrupted quite a bit. So I think that's where the dilemma is. At this point, people are just selling the entire index. They're not even looking at some of the bigger ones or the better ones at this point.
Yeah, well, Anurag, let's get into which ones are the bigger ones and the better ones, right? Because we've seen so far the most vulnerable names seem to be companies in online travel or smaller software firms. But then meanwhile, cybersecurity seems to be relatively insulated from the recent bout of caution that we've seen. Is that a sector or a segment within this space that could actually benefit from increased spending on security?
Yeah, I mean, we did publish a big report yesterday, and we have put out a framework where we have looked at 4 or 5 different segments or different factors. So if somebody has a very high market share, are they selling into an enterprise or a smaller business? Do they have network effect? And are they a platform or a point product company? So, you mentioned cybersecurity. This is an area that is doing better than the others, and in fact, could even benefit down the road if a lot of the agents that people will create would need to have their own identity, would need to have their own safeguards around it. But there are certain places where we will see more disruptions. Online travel is one area you mentioned, and even the smaller software names, whether that's in HR, whether it's in sales automation, I think they are the most at risk of getting disrupted.
What are the companies saying here? Do they acknowledge that AI is a threat to their business? Are they trying to pivot? Are they ignoring it? What are you hearing from the companies these days?
So everybody's pivoting at a very fast pace. I'll name a couple of examples. A company like Workday, which is the de facto leader in HR software, they are creating their own agents. And down the road, when you and I will interact with an HR software company, it would be through a chatbot or could be conversational. There's a company called Figma. It has added more AI capabilities to its core software. So when you're developing the software, you're actually giving prompts to say, this is what I want the design to look like. And then it pops up something, on the system rather than doing it, bit by bit using the software. So there is a lot of push by these companies. But, that's where the question is, whether it's going to lead to lower margins because this is an expensive way to do things, or whether it leads to the AI native company coming and taking their market share.
Yeah, very interesting on that subject, Anurag, of, some companies moving to create their own agents, as you mentioned, because, is that something that could potentially drive a wedge also between these companies that are vulnerable to AI disruption? We had Sarah Hunt earlier mentioning that if you're a company that owns the tech, that owns the proprietary data, you're fine. But maybe if you're leaning on somebody else to provide that for you, maybe you're not. Would you agree with that?
Yeah, if you have your own data, that's fine. But at the end of the day, it's customers' data. It's Bank of America's data. It's JP Morgan's data. So if they decide to give access to an LLM or an Anthropic or an OpenAI to that data, so it's up to them. Frankly, I understand you can't log into somebody's software and try to get that data out of it. So I understand a lot of these arguments, but frankly speaking, when disruption happens, it happens very fast.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.